Hey, welcome back, everybody, to another episode of the Second Alarm Podcast. It has been a minute since I've done an episode, but I wanted to bring on a good friend of mine named Ty, that is a State Farm, or excuse me, not State Farm. We don't want to say that.
Oh boy,
Goodness gracious, we don't want
we're
to say
starting
that.
off
Yeah,
bad
we're already
already.
starting off bad. American Family, excuse me. I've got it in my brain because the fire chief in my local area, his wife is a State Farm person. So American Family. I wanted to bring him on because there's a lot of crazy things that are going on in the insurance world right now. Specifically for us, we've just seen a lot of choppy waters lately, and we wanted to kind of get in and discuss it. And for those of you guys that are in commercial investing, you may or may not know it's coming. You may not even hear about it. If you've been in a policy for a long time, you might get dropped out of nowhere. A lot of this stuff is going on, and I wanted to bring Ty in to talk about kind of the what's going on, why it's going on, and what you can expect along, because we always talk about lending, we always talk about interest rates, we talk about those things, but this is an expense that we don't usually talk about or people don't think of, and it can really derail your deal. So Ty, thank you for jumping on.
Hey, thanks, Seth. I really appreciate you asking me to be on. It's an honor to be on the show and give you a little background about our agency. We're Kashmiry Associates Incorporated. We represent American Family Insurance. We do auto, home, business, and life. The business portion that we're talking about, which in the insurance business, they call it habitational insurance. We are experts in that field. This is our 25th year in business. We're the largest American family agent in Ohio, and we're in the top 20 percentile of the company. We specialize in this. We do it day in, day out. A lot of our policies that we insure are condo associations all around Ohio. So we go all the way from up to Cleveland down to Cincinnati. So we insure the buildings, and then, of course, we will insure the individual unit owners if needed. We also insure HOAs. So you have a lot of neighborhoods that have an HOA association. We insure that. But then, of course, we insure investors. We insure people that might have only one rental property up to people who have hundreds of rental properties. And what we're talking about today is how the market has changed. The market is hardening dramatically. What you're going to see, if you haven't seen it already, is rate increases on your premiums are in double digits. And it's the first time since 2001 in the first quarter of 23 that they've seen over a large over the country is a 20% or higher increase on premiums. So that might surprise a lot of people when they get their bill this year. A lot of that has to do with reinsurance. What happens is, let's just say that we're going to take a complex and it's $30 million. The insurance companies, they contract with reinsurers, and reinsurers take on some of that risk. So back in the day, it would be 50%, but that's changed a little bit. It could be as low as 40%. So if there's a total loss on that 30 million, 50% would be the insurance carrier that you signed up with, and then the other 50% would be a reinsurer. Well, reinsurance rates have gone up dramatically, and a lot of it has to do with the weather we've been having. It's just continuous. We're not getting a break. Last year with the hurricanes that we had, you can see rate increases in Florida, in the state of Florida, at being at 100% or higher. Does that translate to everything in other parts of the United States? Not exactly. But what we're finding is that companies are really looking hard and long at habitational risks right now, especially in 2023. And then you throw in that the inflation, right? To build something, to rebuild something, and the construction costs, the labor, all that kind of stuff factors in. And what happens is that insurance companies might not be getting the premium they need to go ahead and replace the cost that they're asking when construction comes into play and we have a fire or a tornado or a hurricane or things like that. So that has really been the market right now. Insurers are basically sharpening their pencils, and there's a lot of changes. And some of the changes are rate that we just talked about. Some of them are deductibles. And what you said in the intro are that they're getting rid of some cases. They're just saying, hey, we don't like this in our appetite, so we're going to go ahead and flat out cancel.
Yeah. Hey, let me jump in, because dude, there's like a
Sure.
whole lot of nuggets right there that we just
Sure.
that I want to kind of circle back to. So for those of you guys that don't understand, can you break down? I know because you mentioned it, but like reinsurers, like walk me through it because how it like it's broken down. Because I think that again, we always talk about interest rates and people talk about cap rates and people talk about interest caps on your interest and all these different things that can wreck your deal. And a lot of people don't ever think about the insurance portion of things, right? They buy value add multifamily. They're like, hey, this is great. We come in, we're going to do some renovations, construction. They don't necessarily think about how they're going to get it insured in the beginning. And at least what we've seen, and obviously you and I have had multiple conversations offline about this, but is how drastically things have changed even over the last 6 months, where a deal that maybe I would have looked at a year ago and I could have gotten insurance on it is uninsurable now or very, very hard to get because the rates have gone up. And that is, when you're plugging numbers into underwriting and you're trying to pencil out something to see, does this thing make sense or not? We always try to use fresh numbers, but how do you, for instance, we've got properties where the premium doubled, this year, like, and you worked with us on those where, we for no reason got canceled. We go back to get insurance. Now we're, when we got insurance 2 years ago, here was the rate. It was great. That's the number we plugged into our underwriting. Everything was good. All of a sudden we're getting dropped. We're getting a non-renewal because of, like you said, the risk factors. We go back to market. What are we going to get for insurance? And all of a sudden we realize our premiums have gone up 40%. Well, that changes the underwriting. It changes the returns. If you're syndicating, all of that cuts into your overall cash flow. So why, two things you said is one, the reinsurers. What is that? Like maybe break that down on how that all works. And then the premiums, like maybe walk me through that. Like, how is that, like, how do they figure that out? I've always, it's always confusing,
Sure.
right? I just go off of what you tell me or whatever agent is.
Sure. Yeah. So think about reinsurance as just another layer of coverage. And what is happening is the insurance company is working with reinsurers to have that extra level of coverage, which they have to pay for. And by having that extra level of coverage, the premiums could go up. If the reinsurers rates go up, right? Somebody's got to pay that. So then
is that like insurance for the insurance then?
You got it.
It's insurance. It's like a loss mitigation for the insurance company. So if
That is correct.
So if I have a policy and it would replace my building at 100%, 50% of that is going to be paid by the insurance company. 50% of it's going to be paid by this other entity.
That is correct.
And what would make that go up? Like what makes that change? Because that seems like, again, you're talking like multiple layers deep on something that ultimately will affect my underwriting and affect the cash flow of my property. How does that relationship work? Or how does that even, is there a way for me to safeguard against that?
There really isn't. And it has a lot to do with construction costs going up dramatically after COVID. It has to do with inflation. And it also has to do with the fact that we had a hurricane in Florida that cost billions and billions of dollars. So all those factors, all in one, in a quick, short period of time, has created this problem that we have with habitational risk, where if we call what we call a loss hit account would be a property that you're trying to insure that has had losses, where insurance companies look at it and say, hey, we want this off the books. We're not going to renew it. And then you try to go out and get a different carrier. You'll have a very difficult time finding a different carrier to take that, or rates can go increase it 40% to 80%.
Yeah.
So what reinsurers are saying is they don't want to take the risk on certain things. And what they have done is said, hey, we're going to take this pocket of risk, or we're going to go ahead and look at the insurance company as a whole, see what their portfolio looks like. And if it's not what we want in our appetite or what we want in our portfolio, then either the rate's going to be a lot higher for that extra level of risk, or they're just going to say, we don't want to participate at all.
Yeah. Are you seeing like more, like what right now is harder to either get insured or keep your insurance? Is it like A class, B class, C class? I mean, again, I feel like this is where the C class value add that most multifamily folks are buying in the last few years is going to get squished, or is really going to be tougher to insure. The deal, again, like I said, you bought a year ago, you might not be able to buy it now because the insurance would kill it for you.
So the insurance companies can't look at it with an A through D class, because that's illegal. All right. So what they have to look at is the risk itself. All right. They can't say,
Right.
hey, we're not going to insure anything in bad neighborhoods because we think it's a greater risk. Can't happen. So what they look at is the risk itself. First of all, does it have any claims? If it has claims, that's going to be a serious issue for anybody who's trying to get insurance or trying to get a lower rate. So that would be the first thing that they would look at. The second thing is the size, Seth. The bigger the complex, the more insurance value that is on the property is going to be another risk. And then how many buildings? I think when I was helping you out with your insurance, the first question I said was, how many buildings? Because different carriers have different appetite on how many buildings they want to insure. Some will say, hey, we're only going to insure 15 and less. Or some will say we'll go up to 30. But there's not a lot of people that want to go above 30 right now. So that could be an issue where there's too many buildings. And when you think about buildings, it's really comes down to wind and hail. Having 50 roofs is a lot riskier than having 5. So those are some of the things that the insurance company looks at. And then you asked the question a little earlier about replacement costs. How does that work? All of us have software. We get all the measurements. We get all the facts and figures. We put it in a software, and that gives us the number in which we will insure the building for or buildings. And that is what the rate is based on. Most of the rate is based on that. There are endorsements and other things that can add into the rate and liability, but a lot of it comes from that.
Yeah, that's great. And one thing I think that I wanted to talk about was depending on who you're using for insurance. Like there's some people and other investors I've talked with where they'll call their agent or they'll call their insurance broker and they'll get a quote over the phone, email, turn in all your docs, whatever. And here's the premium, and that's what they underwrite to. And nobody ever goes out to actually evaluate the property. Nobody ever sets foot on it. And then 6 months later, after the thing's closed, somebody shows up from the insurance company, or maybe it's on that first annual renewal, and they actually walk the property, and all of a sudden it's like, whoa, like, hey, this thing's either not insurable, or hey, there's something that's found in the inspection period. And I think what's common, is it more common for people to, I know for you, like you send people out almost like preemptively so that you're the most accurate. And I've had it happen to me, and I've watched other people, they don't send anybody out, and then 6 months down the road or a year down the road, our premium goes through the roof because they finally sent somebody out to get eyes on it. And it's not what they thought it was, even though we've answered all the questions.
As an agent, you're supposed to be the field underwriter. So it's your job to go out and take a look at the property. And what's happened in the past is the agent didn't go out and look at it. And then the company does a little research and says, hey, we probably should go out and take a look. They send a corporate person out to take a look. And then they see that there's a lot of issues that the agent didn't reveal. And then that's when you have an increase, or maybe it's set up to cancel at renewal, whatever the case may be. What we try to do at American Family is we go out and see everything. And if American Family wants me to go look at it, I go look at it. But now with the market the way it is, in certain parameters, we will send a corporate person, which we call loss control. They'll go out and inspect it, give a full report back to the underwriter so that we know exactly what we're getting into, so that we have the rate that we give you is accurate, and that we're not changing it after the policy has started.
Yeah. And I think that it's important for people, if you're new to the commercial real estate, or in investing in general, and you're underwriting these things, it's important to understand that, because you're underwriting to a number that you believe to be true, only for it to be changed in 6 months or to a year. And so again, the two things that I've learned over the years is having somebody come out to inspect. So even if the person that we're working with to get insurance doesn't require it, we usually will, or we would, we now request it, because we're like, hey, because we are trying to limit the unpredictable items from changing. So that, and then, like I said, the loss runs, when I got into this game, I didn't even know what loss runs were. And some insurance folks would ask us for it. Some people wouldn't, and they didn't because the carrier didn't. But then, so we buy the deal, we get it insured. 6 months later, they're like, hey, or they're at the renewal, let me see the loss runs. And then you go back, and either you don't have them, which has eliminated us from some carriers, or you find out that there was a claim. And had you known there was a claim back when you were originally underwriting it, you would have underwrote for a higher premium, because I've seen we were underwriting a deal, and there was a dog bite 2 years prior. The people that we were buying it from didn't even own it then. And it was like a $50 payout. It was something minor, but because there was a claim on there, it was going to increase our premium by like $5,000 a year. which is a big deal when you're underwriting it.
100%. I think when you're looking for insurance, you have to approach it the way I approach it as an investor. I have a lot of rentals. I approach my when I do business, and the team that I've set up is it has to do with doing business with other people who do investing. So in other words, my finance people are people that have rentals. My realtor has rentals. I try to deal with people that are in the business. I think you have to have an insurance agent who understands it, maybe has rentals themselves, and also does it day in and day out. Anybody can go ahead and insure habitational risk, but are they a professional in it? Do they do it day in, day out? And do they see where you're sitting, Seth? Do they understand due diligence? Do they understand making sure how to write a deal up and making sure that's not going to change? And I think they don't understand how it can kill a deal for you. You do all this work, all the due diligence, and in the last minute, they're like, oh, by the way, the premium's double, or we can't make an offer to you, and now it's killing the deal. So my suggestion would be to work with somebody like myself who does your part of the job as an investor and understands it 100%.
Yeah. And I think that's the biggest thing is you do a deal, you got good cash flow coming in, everything that you told the investors is coming true and it's working out and everything. Then all of a sudden, bam, you get slammed with this rate change out of nowhere. And it really can, the investors that they don't understand that. They don't know, they're like, how didn't you know this? How didn't you foresee it? And it could have been easily, the plan could have been adjusted, or the price that you were paying could have been reduced based on, like I said, pulling loss runs, having it truly inspected, like understanding and getting down to the real number, which I think has come back to bite not only us, but also other people, early on when you didn't know any better.
Some other suggestions I give people is to go out and meet with the insurance agent if they're going to be the field underwriter or loss control. And the reason I say that is it's always good to understand what the insurance company is looking for, so that on your next deal, when you're walking the property, you kind of can understand, hey, this is probably not going to be great for insurance, or I see this issue, or the roofs look really bad. That's going to hurt me. Those kind of things are things that you can learn from loss control or an agent by walking the property, and they can point out to you, hey, these are some of the concerns the insurance companies are going to have, or this property looks great. I don't see any concerns here, and these are the reasons why. I think always when you can sit down and go through due diligence with the insurance agent, it's going to help you on future deals.
Yeah. And some of the stuff that they're probably looking at, if your plan is to come in, like in my world, we come in, we do a cost segregation study, and then we're going to replace all the roofs, or we're going to replace a lot of these problem areas. And it's great to, like you said, work alongside your agent and just have a plan, and I think that's the biggest thing that can really mess with people, especially right now with everything else that's going on, is eliminating all the unpredictable factors that you can. And this is a great way to do it. So, I would not that you have a due diligence checklist, but I mean, I think that's something too to people should be asking you for, is like, what should I be looking for? Because that's, there's a lot of things that, like you just mentioned, that if you're new to this, you could pull from that and say, hey, when I am doing because when I bought my first deal, I didn't really know what I was looking at. I mean, I kind of thought I knew what I should be looking at, but it could have been a lot worse, and I just didn't know. So if you're new, it could be something great to add your arsenal or the tool in your toolbox. But a lot of people say, good attorneys and good insurance is what can save deals, especially if something goes bad. Because again,
Sure.
Coverage is, people sometimes want to cut the coverage to save, but I can tell you that a good friend of mine had a building burned down, and his agent was giving him great premiums, but they were great premiums because it wasn't high enough coverage. And when the thing burned down, they didn't have enough money paid out to them to even tear it down. And they had to go to the city and say, hey, we can't rebuild it, and we don't have enough money to tear it down. What will how will you help us? And they ended up, took all the insurance proceeds plus lost all of their initial investment to try to get it mitigated. And it all came back to the fact that their insurance, it wasn't the premium looked good, but it wasn't the right fit for what they needed. And, God forbid it burned down. But as a fireman, I can tell you apartments burn all the time. We would go to them regularly here in Columbus. So
yeah, I think that's a mistake of a lot of investors, is they get the number that fits Seth for cash flow, and that's all they focus on. And what they really need to do is sit down with their agent, go over the coverages, understand the coverages and how it's going to protect them, because if they don't, they could find themselves in that situation that you just talked about, which is being underinsured. And that's why we have such volatility right now. Think about this. In the last 3 years, the average price per square foot was anywhere from $60 to $75 per square foot for replacement costs. Now it's anywhere from $180 to $200,000. So think about 3 years ago, the insurance company is saying, hey, we're estimating the replacement cost being this. And now it's tripled, and they're not getting the premiums, right? They weren't getting the premiums 3 years ago of 180 to 200. They were getting them for 60 to 175. And that's what you're seeing right now is they're trying to make up that premium, which is very difficult to do, especially in 1 year. So what some insurance companies are doing is saying, hey, there's certain types of buildings or appetite that we don't want, and we're gonna let it go. We're gonna let the business go, because what we feel is we cannot keep up with the replacement costs that are required if something happens to our portfolio due to a storm. So we're just going to cut right here. So that's where you have to understand is sometimes a lot of people are like, oh, they're just raising it because they're tacking on to the inflation thing and everything's going up, and that actually that's not the situation here. The situation is construction costs have gone through the roof, and insurance companies don't have the premium bringing in the premium to offset it, is really what it comes down to.
Yeah. So let's talk about you as an investor. That's one thing that I love when we first met is that not only, are you, like you said, you're looking through it through a different lens. When we talk insurance, it's not just your average regular insurance person, but you're also an investor. You have a pretty solid portfolio. You're managing a bunch of the stuff, with your team. Like, what does that look like? Let's kind of pivot and talk about how did you get into real estate? How did you scale to where you're at now? Like, what is that? Because I love that. I mean, that's what you want is somebody that, like you said, you're not only looking at it from an insurance carrier lens, but also from the investor lens.
Yeah, I think where it started is I loved inspecting buildings. You learn so much about how a building is from the ground up. And back in 2012, I started flipping homes, had no idea what I was doing. I'll give you a funny story. I went out, I got a realtor who I didn't interview or anything. And I bought this house, and she was doing she was going to do an open house. And she calls me up and says, it's summertime. And she says, hey, listen, you got to get the AC checked. You have that warranty on your policy. Have them come out and check the AC. So I send the guy out to check the AC, and he calls me up and he goes, oh, we have a problem with the AC. And I'm thinking, yeah, no kidding. That's why I called you out there. He goes, there is no AC. And I'm like, what do you mean there's no AC? He goes, there's no AC here, buddy. There's never been AC. So I called the realtor back and I said, hey, we don't have air conditioning there. And she goes, that's not true. I know we did this deal. I remember it being checked on the box, blah, blah, blah. So she goes to the place and finds out that there's no AC, of course, right? And calls me back, says, hey, how quick can you get the AC installed? So I'm like, I'll get it installed right away. I get the AC installed. 2 days later, she goes back to do another open house, and she calls me up and goes, hey, I've got some bad news. And I'm like, what's that? She goes, somebody cut the cord on the AC and stole it. So I'm like, oh my God, what am I doing? And her first question was, when are you going to get a new one in? And I said, when I close is when I'm going to get a new one in. I sold it, made some money, but I learned a lot of lessons, right? A lot of people talk about how they never lose money and it always goes smooth, but that's not the case. So I got a new realtor. I learned a lot. And what my goal is I saved 60% for my kids' college education. I needed to make up the other 40% because I wanted to make them whole, and was able to complete that goal by flipping a lot of houses. In the meantime, once I got that taken care of, college was paid for, my next goal was to save a lot of money to buy long-term rentals, which is what we've done. We have 31 units. They're all multi-family units, and we self-manage it ourselves. We're going to probably get to the point where we get to 50, and we're going to have to turn that over to somebody else. And we also have one Airbnb in Florida. So it's been a lot of fun. We learn a lot every day. There's always stories to be told, but I love the business. I think it's It's very rewarding when you flip a home and you get it to a new home buyer. And then when you buy an apartment and you make it a nice home for somebody to stay and live, I think that's the rewarding part. And then, of course, there's a lot of advantages of being an investor in real estate.
Yeah, no, it's great, man. I love it. And I love that you, like you said, you started flipping, you learned some lessons. I'm sure you opted to not buy in those areas again after you,
Yeah.
yeah, as soon as you didn't have to anymore. And
Yeah,
because that's the, that's kind of the thing. You start where you can, but man,
sure.
that's a rough one to learn right there.
Yeah.
When you buy that and then it's gone the next day, that would be rough.
Yeah. And then she wanted to know when I was going to install the next one. I'm like, probably not soon.
Yeah, yeah. So what's your plans for the future? I mean, I know your guys, as far as an insurance company, are doing very well. You guys are, but let me ask you this, I guess, as we kind of wrap it up, is like, what is the benefit of, like, obviously people can go get insurance anywhere, but what's the benefit of them being with somebody who's more of like a hands-on person? Like I said, you and I talk regularly. You insure some of our stuff. Some of the stuff doesn't make sense for you to insure it. I mean, like, it just, we always look at it like we're friends, but we're also like, it's business and it is what it is. But one thing that I love is that you're very hands-on, you're very active. We've had insurance agents in the past that they're not remote, but I mean, it's like there's not a real solid relationship with them. How does that make you more valuable over, me picking up the phone and calling a 1-800 number and getting insurance through whatever company? Or we have people that call or email all the time, and they maybe they're in a different state and they want to, hey, I want to work with you on your insurance and whatnot. Like, what do you think having that kind of hands-on relationship with the investor, why is that more beneficial than like, if as an investor, I guess, why would I want that? Why would that be of value?
Yeah, I think when you look at an insurance agent that's doing this, the first thing you want to know is, do they have a team that supports the agent? In other words, we have some in-house people. You've dealt with Allison before, where if you need something, it's fast, right? And they know just as much as I do and can handle all your service needs. The other thing is that you can talk to somebody, right? You can call me up and get me on the phone, or you can get Allison on the phone, and things change all the time, where the lender needs a certificate, or there's some additions that you made that you want to make sure that those are covered on your policy midway through the policy. The other thing is that you have to have an agent that's basically going to tell you the truth and understands the market and how the market's changing, and is able to make those tough calls. I think what happens is sometimes agents don't want to call. We know, Seth, 180 days before the policy is going to renew, what the rate's going to be, or if they're just not going to renew it. And that is a phone call that you need to make immediately, especially if they're not going to renew it, because the client needs to have an avenue to go out and get a policy somewhere else. I think sometimes agents just don't like confrontation, or they don't want to tell the bad news. And you got to be able to just say, hey, unfortunately, this is the reason why we're going to have to raise the rate, or we're not going to stay on the policy. And here's some suggestions that I would make for you to find a different policy. You also have to have an agent that when you're thinking about making a claim, I think sometimes people think, well, I have insurance, I should make a claim. Frequency is more serious than having a large claim. Frequency shows the habits as an investor that, hey, I'm just paying for insurance, I'll claim anything. Insurance companies don't like that, especially in habitational. So you have to have somebody to get advice from. That's where you call your agent, say, here's the situation, what do you think I should do? And that's where you have to have an agent to be able to say, here's some of the things we need to think about, instead of just saying, just go ahead and make the claim. And then you go down the road, you get a renewal, and the rate's gone up, like you were talking about, it could go up 5,000. You're like, if I would have known that my rate was going to go up 5K, I would have never made the claim. So those are the conversations that you have to have. You have to have somebody that's readily available to talk to you. But the biggest thing is being in the industry, doing it day in and day out. These one-offs, because I know my uncle and he's an investor and I've done a couple, is not enough experience to take care of people that you work with, Seth, and people that are watching this. You got to have a professional that does it and has done it for a long time and has saw the ebbs and flows of the market, because we've been in situations like this before, and it'll correct itself. I think once we get to next year in the first quarter, I think you'll see things will lighten up a little bit, but we got to make sure that we're okay through the hurricane season, which is going to be July to November, and to be honest, last year was a moderate hurricane season. So we've got to have something lower than moderate for this thing to slow down a little bit in regards to cost to the investor. And of course, any person that's out there trying to insure habitational risks.
Yeah, no, it's great because a lot of times you wouldn't even think. I mean, I do now, but when I got started, you wouldn't even think that hurricanes in Florida could affect you in Ohio. You know what I mean?
Yeah,
Yeah, but it's
100%.
just it's the company's looking at it on a national level, not just in your local area. So, and I think that one thing that you mentioned there, and we'll kind of end with this, is that the for investors, if you're somebody watching and you're looking to invest in deals or with an investor or a syndicator or whomever, like ask the right questions, because this is something again that can they're showing you a spreadsheet of XYZ, and this is what the deal is going to look like, and this is what the return's going to look like. But like, it's just one of those things where you should dig in a little bit deeper and ask a few more questions about what have you done to understand the insurance portion? Because again, like I said, a $5,000 jump in premium or a $15,000 jump, I mean, whatever it might be, can alter that underwriting tremendously. And all of a sudden now you getting paid this preferred return, it completely goes away.
Or you have
depending on the property.
investors. Yeah, or you have investors in your deal, and you're looking to get them a return, and it's altered their return on the money that they've lent you to do the deal. So just like anything else on due diligence, it inside and out how to make sure that a property works. You got to know the insurance. You can't just trust somebody with just saying, hey, yeah, that's the rate, that's what I'm going to plug in, it's going to work. You got to ask a lot of questions and get with somebody who's willing to be a teacher, really, and want to teach you exactly what's going to happen with insurance on these habitational risks.
Yeah. Awesome. Well, Ty, if somebody wants to get a hold of you, what's the best way for them to find you? Whether it's social media or website, what does that look like?
Yeah, we're on all platforms on social media. Our website is TyKashmiry.com. They can reach out to us there. And then, of course, we have all social media platforms.
Awesome. Yeah. So if you're in Columbus, man, take a look at Ty's website, give him a call or give his team a call and see if there's something that they can help you with. Because like I said, I know that we were in a crunch recently and he came through and really helped us, take care of our situation. So it's great to have you on, man. I really appreciate your time, and hopefully you have a great week.
Thanks so much, Seth. Great talking to you.